Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. So I just let you have a look at the couple of disclaimers that I need to show you. I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These can be stories or narratives, which can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them in the question box along the way, and we'll be more than happy to try and answer those as we go, or at least at the end of the webinar. Okay, it's just after 11 a.m. in London. It's June the 18th, so let's get after it. We'll just show you here what we hope to get through in the next 30 minutes or so. We'll just check out how markets are trading currently. We'll look at some of those key themes as well. Of course, the Middle East conflict is front and center, and obviously trade war, trade deals are bubbling in the background, of course. We'll then just review a couple of the main events that we've seen recently in markets. So that's the Bank of Japan meeting this week, and then we did have US inflation data out last week. That is important, of course, for tonight's Fed meeting, the FOMC meeting tonight, and then also we get the Bank of England meeting tomorrow. So a fair bit to get through. I just want to, firstly go through, the first couple of items here. So markets trading this morning, oil's off just a touch after being pretty volatile this week already. So we had the big ramp up, of course, and we'll look at this chart shortly. We then had the sell-off on Monday on the possible ceasefire, which didn't happen, of course, and then we've had continual ramping up really in this pressure, geopolitical tensions really, especially with the potential for the US to get involved. So yes, oil just off the recent highs, dollar trading softer, as it is trading in line with oil really at the moment, and risk off tendencies. We're just seeing some of the commodity currencies finding a bid, with the Aussie and Kiwi up 0.3% and above. Gold just selling off now, and futures, US futures at least, a touch in the green really. Current themes then, of course, it's around the Middle East conflict. This is the chart from Friday's big gain in Brent crude, the highest since 2022, as you can see. And I just want to check that you can see this, that you can. So yes, of course, they're exchanging further missile strikes over the past few days. The fears, as I say, are of a wider conflict, and it's starting increasingly likely, potentially, that the US, as I say, will get involved in the ongoing conflict. Apparently, Trump's inner circle, similarly as the Republican Party, is divided actually by the issue of whether or not to intervene. And the US, interestingly, the US Director of National Intelligence, actually, who's known for their interventionist policy approach, has said Iran was not close to having a nuclear weapon. But Trump has openly, openly challenged this view. So a bit of discord there, and maybe not why we're seeing the US get involved just yet. We have had evacuations of quite a few embassies, the US embassy amongst many others, I think, in Jerusalem from today until Friday, if that means anything. So a lot going on there. Of course, Israel at the moment has avoided targeting directly oil fields and crude oil export facilities, although I think a natural gas processing plant was hit over the weekend. And that's why we've seen sort of this yo-yoing in oil prices, really. As I say, Iran wanted a ceasefire, according to some media reports, on Monday, and that saw oil sell off quite sharply, but then it's been bid up again yesterday, and we're just sort of consolidating up just off those recent highs. That surge then, the most in 3 years, Just remember, and for your guide, of course, Iran is the third biggest OPEC producer despite US sanctions, pumps around 3.3 million barrels a day of crude oil, exports roughly 1.7 million barrels a day. The loss of this export supply would basically wipe out the surplus that was expected in the fourth quarter of this year. That said, OPEC does sit on around 5 million barrels of spare production capacity a day, and so any supply disruptions could prompt OPEC to bring this supply back onto the market quicker than expected. All in, though, a big potential threat to oil supplies, really. A unilateral Israeli strike on nuclear targets has been regarded as a risk that could change the picture and was generally regarded as unlikely until now. Key questions, really, three key questions still valid. Of course, does the US get involved? Will Israel attack and disable any oil production facilities rather than potential nuclear targets? How will Iran respond, whether they close the Strait of Hormuz, obviously, thereby blocking much of the Saudi oil supply as well. That is a critical question for oil markets. And then whether Iran escalates to include direct target attacks, on US or even European targets. Yes to any of these three would raise the risk of significantly higher oil. All three were to occur, then obviously prices probably rise into three figures. And then some sort of superpower confrontation also then grows. Of course, the longer the conflict continues without a yes to those three questions, and it's easier for markets to decide it can look through this. A trade, of course, that has, after all, worked pretty well over the last few years, that trade, looking through these sort of regionalized, localized conflicts, if you like. The US, just remember as well, is a net oil exporter, so it stands to really quite survive really this conflagration really better than other developed countries. That would tend to support a shift back to US markets from the rest of the world. So that is just something to bear in mind. Of course, the combination basically of rising geopolitical risk and oil prices has, of course, temporarily re-established some safe haven appeal for the dollar at the moment. We saw yesterday a big jump in the greenback, and that was likely exacerbated by some positioning squeezing and triggered, of course, then by that new leg higher, if you like, in oil prices. Of course, if the US joins Israel explicitly, then the upside risks for oil jump, and that should help the dollar too. That said, again, higher prices will need to be backed by evidence of supply disruption. And regarding the Fed, we'll go into what we expect from the FOMC meeting later or shortly, but any major escalation in the Middle East tensions means the Fed, will be nimble, of course. A significant and sustained increase in oil prices could actually bring a rate cut forward by a meeting because of the damage it will do to the economy, which is basically harder to fix than waiting out the temporary acceleration in headline inflation. So just bear that in mind as well. And that is kind of all our thoughts on what is happening in the Middle East at the moment. In tariff news, if we just move on to this chart actually, which obviously has seen a calming in tariffs really, the taco trade sort of being alive and well. That is, of course, the acronym coined by an FT journalist that Trump always chickens out. So really sort of the art of a deal, he would call it, where you go very strong initially, bargain hard, and then sort of meet in the middle, and you create a great deal, of course. The latest tariff news, for the EU is reportedly prepared to accept a flat 10% rate by the US under certain conditions. Of course, just remember Trump initially forced them, the EU that is, to speed up negotiations with a 50% tariff threat. Obviously 10% pretty much already priced in really. So sort of a lot of commentators looking towards the July 8 deadline now. but potentially again that's not as important as we sort of suspected, especially because Treasury Secretary Bessent basically said the deadline can be extended for countries who are negotiating in good faith. So all in, that has helped stock markets, certainly helped stock markets with this V-shaped recovery. The S&P as well, back to, well, pretty much back to green since inauguration day. January 20, of course, you can see there very close to that 100 mark. This is rebased obviously to 100. But really markets, yeah, continue to price in better, potentially better global growth ahead, trade deals, expansionary fiscal, and then also monetary policy easing around the globe. Of course, that is aside, of course, from any further escalation in the Middle East. Let's actually, just before we move on, let's just quickly look at oil, which is obviously driving markets at the moment and driving risk on, risk off attitude, as well as the dollar, as I've mentioned. So just checking you are looking at the same chart, which you are. So here you can see oil. Where are we? The black line is the 200-day moving average. That's at 71.65. This is Brent crude. We've just got above here, or we're just trading around these April highs, around 75.34. So interesting whether we can sustain this move above here. Just looking at some fib levels from the high in April last year down to the April low of this year. So the halfway point is 74.95. Next Fibonacci level 61.8 is 78.89 bucks, and then you've got these highs from January of this year and October of last year around sort of 81.60 or so. So interesting whether this is just bullish consolidation before a move higher. We are kind of overbought on a couple of different momentum indicators there, so whether we just get some consolidation around this level, the 75 level or so, before then a push higher. That recent high is at 76.98, and then you've got, as I say, those major highs from January of this year, the year-to-date high just above 81 bucks. So that's Brent crude. Let's now just move on to just a quick review actually of last week's main events. Firstly, we'll look at the US CPI data before then looking, actually, yeah, we'll look at the Bank of Japan actually meeting before then looking at CPI, because then that rolls nicely into the Fed meeting. So Bank of Japan meeting, which is here. Well, interestingly, we had this chart up which shows us the core CPI moving at the fastest pace in over 2 years. But the Bank of Japan, well, they left rates unchanged at 0.5%. That was widely expected. Then with an 8-to-1 vote, they decided to keep the current tapering pace of their bonds buybacks really in place until March 2026, but then reduce that pace from then on, which was also as expected. So that means the current bond purchase of about 4 trillion yen per month will be reduced to 3 trillion yen by March 2026, and then 2 trillion yen by March 2027. That will be subject to an interim assessment at the June 26th meeting, and basically suggests the BOJ wants to keep all its flexibility. Otherwise, markets really quite quiet actually on the decision, not expecting much for the remainder of the year in terms of rate hikes, as they pushed really money markets pushed the next one into early next year. Basically, the Bank of Japan was pretty, well, relatively dovish compared to expectations. They noted moderating growth and sluggish underlying CPI, but said that both would rise in the medium term. The bank mentioned trade in particular as a risk to the outlook, and upcoming wage data confirming the solid negotiated pay hikes in the spring, and perhaps a deal with the US might give room for a clearer picture going forward. Governor Ueda's remarks suggested really a reinforcement of the dovish stance, with a lot really dependent on well, these uncertainties and also a US trade agreement, which isn't forthcoming yet. Of course, if that picture changes, then those rate hikes could come back to be priced possibly in sort of October time. But really at the moment, money markets have pushed out the next hike until next year. If we just look at dollar yen, obviously this is buffered a bit, moving about because of the risk sentiment picture, of course, but you can just see, I'll just take off these Keltner channels, but you can just see we moved out of this descending bear channel, got down to sort of 140, 139.88, probably should take that out now. But a decent channel where we picked up above 148, and now we're just oscillating around sort of 143, 144. The blue line, which has capped the upside, actually, you can see recently, that's at 143.98. So interesting whether that is now support or resistance. If it is support, then we've got that spike high as initial resistance at 146.28, and then you've got these fib levels 147.13, and then the swing high from middle of May at 148.64. Otherwise, yeah, 143.98 to the downside, and then obviously if we're moving below 142, then 140, big zone of support. You can see here, cap the downside December of 23 and September of 24. Okay, that's dollar yen after the Bank of Japan meeting. We also had US CPI data, as I said last week. Let me just pull up a chart which shows you the core level really, and it was quite a comforting set of US inflation numbers for May. Both the headline and core rose just 0.1% month on month. Market expectations were for 0.2 on the headline and 0.3 actually for the core. That's also softer than the 0.2 month on month expected outcome for the core measure due to, well, some softness in services, and basically the tariff impacts are not being felt yet, more likely to be felt then later on in, July and onwards, around 3 months probably after the imposition of tariffs. That's actually the approximate timeline that we saw in 2018 with washing machine tariffs, actually, which were hit by a 20% tariff, and that took a few months to kick in, really, as inventory already in the country was not subject to the tax. So it took a couple of months to show up. This chart just shows you, well, the US now tracking around the 0.17 month on month run rate. That's that black line there, which is needed to bring down annual inflation to the Fed's target of 2% or so. So we need to have month on month core readings below that 0.17 reading over a few months then to get us towards the target. Interestingly, I guess there are some falls in clothing and also a drop in new car prices, which helped hold down inflation. And these are areas which are at high risk of price rises due to tariffs. But there's no indication really of preemptive moves just yet in those. Markets then, they did like these numbers, but really we need to be careful of saying that tariff fears are overdone. If we just think about the Fed's beige book, that was from the previous week, actually. It says there were widespread reports of contacts expecting costs and prices to rise at a faster rate going forward. These potentially may be strong, significant, or substantial, and these plans are expected to pass along tariff-related costs within 3 months. So July and August really are likely to see higher inflation prints. Just watch out for those then. And some economists still expect headline CPI actually to head towards 4% year on year in the third quarter. All of that said, though, it's interesting that a lot of economists now sort of mentioning that, and we talked about this previously actually, that potentially the tariffs, of course, are just a one-off price hike that will drop out of the annual comparison in late summer sort of 2026. And also then with rent data falling as well, that accounts for 40% of the core inflation by weight. So that can potentially act as quite a big disinflationary force over the next 12 months as well. More broadly, I guess, as well, just to point out, the US economy, primarily a service sector economy, biggest cost input is the cost of workers. And potentially then, if we're getting a cooling jobs market, then that implies disinflationary forces there as well. And that will also potentially mitigate the tariff impact. That kind of means then looking further out, decent chance really of inflation getting back down to 2%, probably late next year. And it keeps the door open for Fed cuts, possibly later this year. We shall see, and we'll get into that very shortly. In fact, let's look at it now. So just moving on to then the key central bank meetings for this week. The Fed in a few hours' time, widely expected to keep rates unchanged, with the Fed, more than likely to adopt a wait and see stance amid obviously continued uncertainty, both over the economic impact of the tariff policies on growth and inflation, and also, of course, the Middle East conflict rearing its head. Key things to watch will be the updated Fed economic projections and as well the dot plot. And it's really key, as I've put here, is whether the dots continue to point to 50 basis points of rate cuts, both for this year and next. And that is pretty much in line with market pricing, a touch below that actually market pricing, but pretty much in line. Or whether policymakers stick to that, or whether the risk is that they switch to, say, a 25 basis point cut only for this year, and then probably a 75 basis points worth of cuts, 25 basis point cuts basically for next year. And that's given uncertainty on how quickly inflation will slow after tariffs hit, of course. The risks then are skewed to the hawkish side in the near term. The Fed will also release those updated economic projections for the first time since March, of course, when we saw overall estimates of inflation and unemployment were lifted. Recent data, well, they showed pretty decent, solid jobs growth, really, and easing inflation, as we've just gone through, although risks from tariffs, of course, remain. We mentioned about the beige book, of course, seeing plans for higher prices within 3 months. So the summary of economic projections really are likely to show downward GDP revisions and probably upward CPI forecasts, and that sort of points to stagflation. That said, I guess as long as, well, the US labor market doesn't show any signs of cracking, then really the Fed will be focusing more probably on inflation at the moment and those tariff risks. There probably won't be very little, if any, forward guidance from Chair Powell at the press conference or in the statement generally, really. And really, it's probably worth keeping an eye on the balance of risks. So back in March, Fed participants reported that inflation risks had become increasingly skewed to the top side, but the GDP and unemployment risks were better balanced. Then last month, Powell basically verbally stated that both growth and inflation uncertainty had increased, but he kind of avoided specifying which risk felt more pressing at the time. Now, probably it's more a case, as we just said, focus on inflation because of the tariff threat, although obviously there are those geopolitical concerns with rising oil prices as well. Interesting, actually, one final thing to say is that with this energy market volatility, there is an argument, an easy argument really for the Fed and Jerome Powell to fend off Donald Trump's desire for the Fed to cut rates and cut rates aggressively by 1%, I think is what he said. So certainly energy market volatility will probably be a good opportunity to fend off any of those arguments, for lower rates from Donald Trump. This is just a chart actually with the Fed's funds rate and then the Fed's favored inflation gauge PCE sort of still elevated, but possibly slowing slightly. But then, of course, we have those near-term risks to the inflation outlook. If we just pull up the DXY chart then, which is here. And I should just point out, of course, as well, briefly, we had retail sales out yesterday out of the US. Interesting, the headline that fell for 2 consecutive months, kind of unwinding most of the pre-tariff spending splurge that we saw. The control group, which feeds into GDP, that's the one number that the market focused on. That did beat estimates, and so does offer some hope that Q2 won't be a write-off for consumer spending. However, I guess households, it does look as though households are slightly worried about what tariffs may mean for spending power, and then they're also increasingly cautious on the jobs market outlook. So potentially we may see some ongoing cooling in consumption going forward. That was retail sales. As for the dollar index, you can just see still in this bear trend, series of lower lows, lower highs. We are potentially should extend it really. We're just to the top side then, the top of this channel really, but we just come off there. You've got sort of this previous low from April at 97.92, and then obviously the recent lows were at 97.60. Those are long-term lows, and there's very little after that. If you look at other charts, not any major levels really for quite a while. So interesting whether we hold this sort of 98, 97, 60 level and bounce off that, and that acts as major support or not. Okay, otherwise, just quickly, we'll look at the Bank of England meeting as well. And I'll just pull up a cable chart. Just bear with me 1 second. So this is sterling against the dollar. But yeah, Bank of England meeting on Thursday, consensus and market pricing, fully expecting the bank rate to stay unchanged at 4.25%. Vote split likely to be 7-2, with the majority voting for an unchanged decision, and likely Dingra and Taylor voting for a 25 basis point cut. Risks, though, are possibly tilted towards a 6-3 vote split. I think interesting with the vote split, you get an initial market reaction. Certainly we would if we got a 6-3 vote split. So that's another member voting for a rate cut, because consensus is 7-2. But just a couple of words on that. Normally, well, those are external members, and normally the internal members on the MPC vote as a pack. So just because the external members are voting for a cut doesn't mean then we're veering towards that on the committee. As I say, most internal members, they vote as a pack. That is the majority, and they therefore decide ultimately what happens with the vote going forward. The meeting, I should say as well, will not include updated projections or a press conference because it's not a quarterly meeting. So just bear that in mind as well. Overall, though, the bank are likely to stick to its previous guidance, repeating that basically a gradual and careful approach to removing monetary policy restraint remains appropriate. Just since the last meeting, data has generally surprised to the downside. So we've seen weakness in labour market data. We've seen wage growth cooling a touch, although it does remain slightly elevated. Growth has been weaker, negative 0.3% month on month in April, and that poses downside risk to the MPC's projection of 0.1% quarter on quarter for the second quarter. And then we just had CPI data out this morning, actually. Interesting again, very interesting. The headline, that was a touch lower than expected at 3.4%. Core was in line at 3.5%, but the closely monitored services CPI, that did come in a bit lower than expectations at 4.7. Expected was 4.8. So all in, that sort of softer data in general, possibly at the margin, raises the chance of a more dovish tone really tomorrow. And certainly because, as we say, Well, the Bank of England previously had been relatively hawkish, but now backed up by that softer inflation data, softer jobs and growth data, then we could possibly see a slightly more dovish tone by the bank tomorrow. Otherwise, quarterly cuts, that is the sort of pace of rate cuts that we have seen and that generally most think the bank will stick to. There are 50 basis points priced in by markets for this year, and potentially risks to more are possibly going to happen due to downside risks to growth. You can see that's a little bit, sterling has struggled against, not really against the dollar, but against other currencies, other major currencies this month, actually down at the bottom along with the dollar, and certainly this week as well after that sell-off yesterday. So you can just see we've traded out of this bullish channel now, and we're back down to, well, the previous high from late April at 134.34. Just found a little bit of support here, so interesting whether that holds or not. And then you've got the 50-day moving average, the blue line just below here at 133.76. And then if we do hold support, then that recent high is just above 136 or 136.31, if possibly the Bank of England maintain a sort of relatively hawkish hold stance, if you like. Okay, we'll wrap it up there. I don't see any questions at the moment, so yeah, really hope that's all clear to you guys. Really do appreciate you being on the call, and we will speak to you in a couple of weeks. Take care.